All right, I think we're going to get started. So first, I want to say thank you to all of you who tuned in today and spending your time with us this afternoon. I'm Krista Madison, a wealth advisor here at Curi Capital. Since your time is valuable, I'm just going to jump right into it. We do have time allotted at the end for questions. If you want to use the chat to enter in your questions, we'll do our best to answer them towards the end of the presentation. So thanks for joining us. Today, we're going to be talking about managing your most valuable asset, a presentation geared more specifically towards privately held business owners, which I find the majority of them, their biggest valuation in their household and their net worth is the business itself. So today, we're just going to talk a little bit about how we work with our clients, how we determine and track those numbers. Hopefully, you'll take something away today. To start with an agenda, we're briefly going to talk about my background and why I have experience in this sector, plus some takeaways for today. We're going to talk through the data and the trends that we're seeing, and then the actual work that we put in establishing value in your business and how we use that to meet your personal goals, and then closing remarks. So why am I here talking to you about this and what makes me qualified to review this information with you? First of all, again, my name is Krista Madison. I'm a senior wealth advisor here at Curi Capital, and I have over 25 years of personal financial services, wealth management, and financial planning experience. I'm a certified financial planner, which is the gold standard for financial planning advice. I'm also a certified exit planning advisor, which is a CEPA designation, which means I am uniquely qualified to help business owners in privately held business space on their planning and the execution of their goals. In addition to that, I'm a member of a lot of organizations locally. I'm part of the Valley Industrial Association as well as the Illinois Manufacturing Association. There's some accolades in there, which I'm always hesitant to talk about because I don't like bragging about myself. But one of the more interesting things about me, which I was told recently by a good friend that I need to start letting people know that that's in my past, is I was one of the 4 top female soccer referees in the nation at one point, and I played women's collegiate soccer in college on a full ride. And I was part of the inaugural women's team at IMG Academies for soccer. So big sports background. The biggest question I get asked today is no, I do not play still. Okay, so most important themes for today that we want to take away. The first one is having the right advisor. Business owners have specific needs that they need addressed, which means they need to look for a specific advisor that can help them in those areas. Learn what drives your value. We're going to talk about how and what impacts your business value and how you can try to optimize it. Knowing and tracking your numbers is extremely important. We use a system called wealth gap and value gaps to determine where you're at in your valuation and how that can affect your financial goals. And then accessing a network. Making sure that you have access to professionals who can help you increase your efficiency and things in your business and also in your planning. So the first one I like to talk about is the data. A lot of these numbers are pretty astounding. I want to start with where we get the information because we're only going to trust information that comes in that is good information. So there's an organization called the Exit Planning Institute that was founded in 2005. It was started to equip advisors with the tools to help transitioning business owners. They started the CEPA certification in 2007. And the unique thing about the CEPA certification is it can be held by many different professionals. So I'm a financial advisor, wealth manager. I have a CEPA designation myself, but attorneys have them, investment brokers, business brokers. A lot of different professions have the ability to hold the CEPA certification. What the Exit Planning Institute started is what's called the State of Owner Readiness Study. And it was kind of first in its kind where they surveyed independent business owners across the nation to get their thoughts and their feelings on their transition planning. It was first completed in 2013, and the last one that they did was in 2023. They did a special generational report in 2025, but we're mostly going to be addressing the 2023 information. In 2023, 1,162 responders responded to the questionnaire, which is the questionnaire focuses on lower to middle market companies. So really targeting the family-owned, lower, I would say lower than 200 employee organization, which is what we really find as the majority of privately held organizations across the country. And here's what it says. So 4.5 million privately held businesses in America, which equate to over $14 trillion of business worth. 51% of privately held businesses are baby boomers, which today are between the ages of 62 and 80. And here's the information that was presented to us from the study is that 79% have no written transition plan at all. 48% have done no planning, and 94% have not put together what we call a third act plan, which means what you're going to do after the business. What are you passionate about? What's going to take up your time? What's going to get you excited to get out of bed in the morning? Without any third act transition planning, we find that 75% of business owners who sell regret selling within a year. Some other important information, 75% of business owners do want to exit their business in the next 10 years, which is a very large transition. Of all privately held businesses, 70 to 80% simply will not sell and just close their doors because they have not done the planning, they're not prepared for it, and they're not ready to go through that transition. The remaining 30 to 40% rarely sell in their current condition, which just means there's areas in the business that can be improved upon to maximize your value. So my goal and our goal here at Curi is to really help business owners and their families have this conversation sooner in the life cycle of the business so that we make sure that value is continued to maintained and grown over time, and you're ready for that transition when and if it comes. On the next generation information, only 30% of family-owned businesses transition to the next generation, and only 12% survive to the third generation. If you have not heard this saying, it's pretty common in the independently family-owned business circles, which is shirt sleeve to shirt sleeve in 3 generations. First generation builds it, second generation maintains it, third generation kind of lets it go by the wayside. So, and here's the reason why a specialized advisor, or at least an advisor that has the knowledge to help independent business owners, is important. A non-business owner net worth, 48% of their net worth are financial assets and 52 are non-financial assets, which mainly include homes, cars, and valuables. A business owner net worth, on the other hand, non-business related assets make up 20% of their net worth, while business related assets, which is the value of the business itself, including everything that's associated with it, makes up 80% of their net worth. In my opinion, I wouldn't be doing my job as an advisor working with these particular clients if we weren't actively tracking and maintaining this business valuation throughout our relationship, just so that we know what we're tracking towards and what our numbers are. So the next one is, how do we determine what those numbers are and what do we do? What we do is something called a value map program. It's an internal program that we put together for our privately held business owner clients. And I related it here towards an official valuation because in my experience, when I talk to existing business owners, a good portion of them have in their mind an official business valuation, which is costly, time-consuming, and very tough to do. Our program cannot be used for getting loans from the bank or an underwriting for an official sale, which you might actually need an official appraisal. Ours is really just a tool to track the value while we make decisions about your goals and your future. You can see the changes or the differences between the 2 programs is the value map is included with the rest of our offerings for clients. The required documents to me is also a big thing. I meet a lot of business owners who don't have the time or the desire to share a lot of their internal information with people. The Value Map program is 100% self-evaluated. It's 4 questionnaires, 2 business and 2 personal, and it's self-evaluated. You answer the questions as a business owner, and we determine value off of that. It's not time consuming, whereas an official valuation or appraisal is time consuming because you do need to include accountants and attorneys and anyone else internally who's going to grab all these the information for you. And also quick to complete, it's self-evaluation. Answer 4 questionnaires and you're finished. Components in the program itself is, again, we just use it as a tool to monitor and track your valuation and how to use that to help make decisions. It's a surface level evaluation of business and personal strengths and weaknesses. And again, it's 100% self-evaluation. So you're not volunteering sensitive information if you don't want to. We use the information in the final deliverable to decide, what we should work on, where we can focus energy to maybe increase that valuation to get you a better transition sale if we're heading towards sale. We start with the 80% of your company's value is in what I call the 4 intangibles, which is human, structural, customer, and social. I frequently meet a lot of business owners who are surprised at how much these 4 components really drive the value of their company. But if you take a look at it, really does make sense. The other 20% is the physical capital within the company, the machinery, the building, other things, the equipment, the offices, things in the building. So what we do is we give you these 4 questionnaires that you take on your own, and it determines your strengths and weaknesses in each area. The blue questionnaires are the business questionnaires. They're titled Business Attractiveness and Exit Readiness. And the yellow questionnaires are your personal questionnaires. This is Financial Readiness and Personal Readiness. Some of these questions include, what kind of IP do you have? How long has your management staff been at your company? Do you have a great management team? Those are part of the business questions. On the personal side, here we get into some questions about your third act, which is, what are you passionate about? What are some things you're going to do after the sale? Also including numerical questions as far as what you need to maintain your lifestyle, what kind of retirement income do you need in order to live a comfortable retirement. This helps us to determine on the business valuation side if we can meet that information or meet those goals. So each question that you get sent has a grading scale between 1 and 6 that you answer. So 1 is weak and 6 is strong. And you go through the 4 questionnaires and we receive the results. Once we receive the results, you get a business score and a personal score. For this particular business, they had a 56% business score and a 60% personal score, with the total aggregate score of 58%. Now, what do the scores do? This is kind of my favorite part. We, with the resources that we have, are able to pull information from a database for private sale transactions based on your company's NACIS code. So this particular company is in adhesives, creation of adhesives. And we were able to pull from our database private transaction based on the adhesives NICIS code to determine a range of multiples that those businesses have been sold within the last 5 to 10 years. And our goal here is to give you a comparison. Your competitors have sold for these amounts. Where do you land? The particular company who did these questionnaires had a 58% aggregate score, which, if you see the green star, lands them just above average. And the EBITDA multiple range for sales for their particular company from our records is 3 times to 6.6 times EBITDA. So if 6.6 times is the best company you could look for, the human capital is great, the structural capital is great, social capital is great, then that's our range. I would say for this particular company, I would say the multiple that they would probably be looking towards is more 3.2 versus 3 based on their score. And this determines your value gap. So what we do is take a look at, this particular company could sell at 3.2x, but the most attractive company is selling at 6.6. So what you'll see is their estimated business value right now at 2.5 million, but at 6.6x, they could get up to 3.3 million. And that's your value gap. So there's your gap between what you could sell for today and what your top dollar companies are selling for. And then we apply that to your wealth gap. So that was your value gap in the company, and here's your wealth gap. As an example, you see the blue square is the client's current net worth at 500,000. And then we're sitting with the client asking, what kind of income do you need in retirement to live a comfortable life? And their desired retirement income is 250,000 or 190 post-tax. So we need 5 million in order to make that happen. And there's your wealth gap. So we would need an estimate. Right now, their estimated current business sale is at 2.5 million, and they need 5 million. So there's your wealth gap right there. And our goal is to really help our clients close the value gap on their business so that they can achieve their retirement goals based on that sale. How do you do that? Well, 80% of your valuation in your business is in these 4 intangibles. These are just examples. On the human side, maybe your team needs better certifications and training. That's one that we could take a look at. On the structural side, you make sure all your intellectual property has been protected and registered. On the customer side, is your customer base diversified? Can we diversify it better? And on the social side, do you have a mentorship program in your company? Are you present in your community? Do you have good network of professionals to lean onto? These are all areas that you can improve to help improve your multiple. And then how do we do that? So I will be the first one to acknowledge that I am not an expert in manufacturing or dental practices or medical offices, but what I am an expert in is the wealth management and financial planning for people who own these companies. So if we do get to a point where there's a particular area where we could help strengthen that company, it is also my job to build a network of professionals who can come in where that is their area of strength and help you increase one of those areas to help increase your multiple. So instead of taking the time yourself away from the business to find someone to help you strengthen your branding, help strengthen your management team, maybe build a better measure for customer satisfaction. We have contacts with people in all areas who can come to you and say, this is my area of expertise and how I can help you strengthen that area to increase your valuation. And the other thing that we have access to, this is one of the greatest things that my clients and business owners that I work with enjoy, is we do have access to surface level industry reports on your particular industry in which you operate in, as well as the most important thing, at least for the valuation side, the database that I'm talking about of private transactions for companies within your NICIS code range or your industry for the last 5 to 10 years. So we have a gauge on where companies are being sold, when, and for how much. So it gives us the ability to compare and contrast, which I find very helpful and my clients do as well. So in closing, I just want to say, as a business owner, your needs are different. You need someone who is really going to be talking to you about this kind of thing and getting that conversation going sooner than you think it would be, and how to best address areas in the business to help maximize your valuation. The second thing is just monitoring and tracking it is critical. If I had a penny for every single time I met a business owner who didn't have any long-term strategic plans or had no idea where their business valuation stood, I would be a very rich woman. But our goal is to change that. Our goal is to help advisors realize where they are compared to their competitors and use that to help them make strategic decisions about how to grow their business and where to grow their business in the future. And then surrounding yourself with the right team, both inside and outside your business, making sure that you have people there that you can lean on, that you can ask questions to, who have the special, unique, important information that is relevant to you and your business value, which, as I mentioned before, for business owners is the majority of their net worth. So that's what I have for you today. Again, know you're busy. I know how hard it is for business owners to take time out of their schedule, so I very much appreciate your time. My information is on the screen, as well as my calendar link if you want any more information. I believe Hannah's going to join us here, and we're going to answer a few questions.
Thanks, Krista. Yeah, we had some questions submitted in advance, but if you have any during this portion, you can throw those in the Q&A box below. So Krista, the first one is, what are 3 common risks business owners should be aware of?
So this is a good question. I'm going to tailor it towards our topic today, which is business valuation and transition. The top 3 risks within that category are financial anxiety and valuation gaps. This is a business owner's emotional attachment to the business, driving their anxiety on what the valuation they feel their business is worth. And then when they go to list the business, if they feel they're going to get good offers. Sometimes this can kill deals. Sometimes this can make buyers hesitant within the negotiation process. The second thing is operational disruptions. Surprisingly enough, 40% of the businesses that do list for sale, the owner is listing the business and doing the negotiation themselves. It's not a bad thing for them to do that if they feel they have the tools and the resources for that. But I usually recommend clients use a team to help, an investment banker or a business broker to help list and in the negotiation, as well as a financial planner, a CPA, and an attorney to really help surround them with advice so that they can make the best transaction. If you don't have that team and you're doing it all yourself, then not only are you continuing to run your business, but now you have another full-time job, which is gathering appropriate information, talking to potential buyers, and doing the negotiating yourself. With that sometimes comes operational disruptions, and that can help within the however many months that it takes you to negotiate that deal, the business can suffer. The third one is a lack of awareness for personnel and cultural management. The amount of value that your team brings your business is sometimes some of the most important things to a buyer, because when you're no longer involved, your team is still going to be there. So being aware of the fact that they are important in that transaction and how to discuss with them that you're looking to transition and how to bring in the new owner so that they're happy and they don't just leave, and having an appreciation for the culture that's there, I think is also a mistake that I see.
Thanks, Krista.
Sure.
The next question is, how much of my net worth should realistically be tied up in my business?
That's a good one. I'm gonna start by saying most business owners don't have a choice. You are starting this business, and I would also say it depends on the life cycle of the business. If you're just starting the business, every penny you make is going back into growing the business in that startup phase. Once you are building a good foundation and your business life cycle is past the startup phase, how much of your net worth is within it, it's kind of not up to you. It's just based on the value you're growing in the business itself. It's really tough as a business owner and as an advisor for business owners to say, let's not put all our eggs in one basket. Let's make sure the business doesn't constitute 80% of your net worth. Because it just grows to that point, and it's just the the size that it is and the amount that it constitutes your net worth, there's not much we can do about that. But on the flip side, the most important thing that we need to do about that is track it, maintain it, monitor it, and compare it to your competitors.
Great, thanks. Kind of piggybacking off of that, another one was how much should I be paying myself versus reinvesting?
I mean, I'm going to kind of piggyback on the last answer and say this is highly contingent on the life cycle of the business. In a startup phase, you're on what entrepreneurs call the ramen noodle diet, and you are reinvesting everything you're making to really get that business off the ground. Unless you're purchasing an existing business, which a little bit different of a conversation. I'm really gearing this answer towards startups and people who are starting on their own. Once you get past that and you start making some money and you have a good team and a good base of clients, how much you should be paying yourself, again, it depends on the cash flow in the business. What I've noticed is that each business, as it exists in its particular industry, is different on how the cash flow works. Some businesses are very cyclical as far as seasonal. Some businesses are a little bit more regular. So it just depends on the cash flow, and it depends on what you need to keep in reserves in the business and what you need for your own lifestyle. A highly, highly individual answer for a particular person in their particular industry and their particular business.
Thank you. The next one is how do I determine whether selling, transferring to family, or internal succession is the best option?
This is a really good one. I get asked this one a lot, especially from business owners who are thinking about transitioning. And the funny thing is, based on my industry and the transactions that I've been through with clients, is you almost sometimes don't determine that. That is highly contingent on the timing in which you want to transition and your available resources. I speak to a lot of business owners who have very passionate wants that like they want their children to take over the business. But then we sit down and have a conversation on whether or not they're currently involved in the business, if it's something that they want to do they have the capital to purchase mom and dad out of the business so that they can maintain their retirement lifestyle? So there's so many questions involved in what's going to be the best transition strategy. And sometimes a good portion of that is driven by the market. If you can have a strategic sale and that's best for your valuation, private equity, and another big driver of that is where's the capital coming from? Who's going to provide you with a better multiple if family's not involved? But there are great family transition stories that have worked out well. It's just a matter of sitting down and discussing whether or not that's the best option.
Thanks, Krista. I think we have time for one more.
Sure.
I'm gonna just put two questions together because I think they go well together.
Okay.
So, what should I prioritize if I feel overwhelmed by competing goals? And how do I know if I'm actually making progress?
So great questions. They are similar and have similar answers. If you are in the business life cycle where you are looking to sell within the next 6 months, and we do a value map study and we find 5 different areas that you can improve on to help your sale price. That's a lot and not anything that you're going to solve in 6 months. But what we would do is probably talk to an expert in your industry or someone who is in the process of selling businesses just like yours and talk with them about the areas that we could improve and which area should we spend our time in to maximize your value. And then that's what we determine. So not self-determined, market determined. What can we spend time on? And also, how much will it cost? That's another thing. What's the capital requirement to make this particular area of my business better? Because if the capital requirement exceeds one, what you have, or two, what you're going to receive in return for valuation, then we might want to move on to another category. And as far as like how you're making progress, That's why I think our internal value map process is so great. It really does identify areas that we're going to improve in, and we go into those particular areas and determine what we can do to improve them. And we just redo the evaluation within a specific time frame. So maybe we have 6 months to make improvements, and we do it again in 6 months. Um, that program helps us keep a track on how well we're improving. But we also, again, with our great network of other professionals and consultants that we work with, will come in and make sure that we're also improving in those areas as well.
Thanks, Krista, and thanks everyone for your questions.
Thanks again for everybody's time. I really appreciate it. I hope you have a great day.